Adobe stock is down 13% after the company reported its third quarter 2024 earnings. It's also down 25% from its all-time highs that it set in 2021. I initially purchased the stock in 2022 when Adobe announced that it was trying to acquire Figma, and the stock was absolutely collapsing. It then rebounded and ran over 80% within a year, and I took my gains by selling at around $510 per share. Today, Adobe is trading for $508 per share, which is right around where I sold it over a year ago now. And I have been asked by many people if the stock is looking cheap today, and if I am going to consider buying back into it. So in today's video, I want to discuss Adobe's recent earnings, why the stock is down, and if the stock is looking attractive once again. So with that being said, let's just hop right into the video. Alright, so as always, I took some screenshots from Adobe's most recent earnings report, and I want to run through them all very quickly with you. So the first one shows Adobe's third quarter 2024 highlights, where it says, Adobe achieved revenue of $5.41 billion in its third quarter fiscal 2024, which represents 11% year-over-year growth as reported and in constant currency. GAAP operating income in the third quarter was $1.99 billion. Operating cash flows was also $2.02 billion, which I do believe is up about 9% year over year. Remaining performance obligations exited the quarter at $18.14 billion, and Adobe repurchased approximately 5.2 million shares during the quarter. So overall, it looks like Adobe's revenue is up 11% year over year, its operating income is continuing to grow, its cash flows are also up roughly 9%, and the company is continuing to buy back stock. So at face value, this actually does look like a pretty decent quarter for Adobe so far. Now, continuing on, this is Adobe's income statement right here. And we already discussed how revenue is up about 11% year over year. But what I found interesting is that Adobe's cost of revenue was actually down by about $26 million year over year for the third quarter. This means that it cost Adobe less money to actually produce this revenue right here. And overall, its gross profits increased by about $500 million to $4.8 billion for the quarter. However, Adobe's operating expenses did grow by roughly 10% year over year to $2.86 billion versus $2.6 billion last year. However, its operating income did still grow by roughly $300 million to about $1.99 billion, as we did already discuss. So Adobe's income statement does show us that its operating expenses are continuing to grow quite a bit. So let's move on to the company's balance sheet now. And my main goal whenever I am taking a look at a balance sheet is simply just to understand if the company is liquid or if it is in any financial trouble, like if it's about to go bankrupt. It's very rare that I do look at companies that are about to go bankrupt on my channel. And most of the time, companies' balance sheets are just pretty good. They're not like incredible, but they're just pretty good. So let's see what category Adobe falls into. So here we can see that the company has roughly $7.2 billion in cash and total current assets of about $10.7 billion now. Further down the balance sheet, we can see that the company has current liabilities of about $9.6 billion. So Adobe does have more current assets than current liabilities, which does suggest that the company's balance sheet is quite healthy, because it does have more current assets than current liabilities, which essentially means that the company should not be in any financial stress over the next year. It also has total liabilities of about $15.3 billion now, and it's also worth pointing out that the company's total liabilities have increased by about $2 billion year over year. So Adobe's debt is growing. So in my opinion, Adobe's balance sheet is okay. It's not like the best balance sheet that I've ever seen, but the company isn't in any financial stress and it shouldn't be anytime soon. Now moving on to the cash flow statement, this will show us why Adobe's debt is growing right here. So let's just start right from the top, and we can see that stock-based compensation was $474 million, which did grow year over year, and Adobe does have quite a bit of stock-based compensation going on, which is ultimately just dilution to shareholders. Then we can see that its operating cash flow did come in at that $2.02 billion, which is up roughly 8 to 9% year over year from about $1.87 billion last year. Now, the purchases of property, plant, and equipment were only $57 million for this quarter versus $91 million last year. And I got to apologize, everyone. It actually looks like I underlined the wrong line right here in my screenshot, but the purchases of property, plant, and equipment is the actual CapEx for the business. And one of the reasons why I liked Adobe's business so much and why I still think that it is a high quality business is because it can grow its operating cash flows, or the profits that the business produces, without having to invest a lot of money into capital expenditures. I mean, think about this. Adobe spent $57 million on CapEx to produce $2 billion in operating cash flow. and its capital expenditures year over year declined by about 40%, and its operating profits grew by about 10%. So it didn't really cost the company any more capital expenditures to grow the business's profits. And that is something that I do really like about Adobe's business and these software type companies in general. This is something that I see often in the software industry. So overall, this means that Adobe produced free cash flow of about $1.97 billion in this quarter. Now down here, we can see that Adobe repurchased $2.5 billion of shares in the quarter, which means that Adobe is repurchasing more shares than the company produced in cash flow, or in profits. Now, what this overall means is that Adobe is dipping into its cash position to buy back shares. And Adobe does have the cash position and the balance sheet to do this, because again, the company is not really in any financial stress. But it is just worth noting because this is an unsustainable amount of buybacks that Adobe is currently doing. Because if it continues to do this, then its cash position will eventually go down to zero. And I also think that this is why Adobe's liabilities are growing, is because the company is taking on debt to buy back shares. In my opinion, I do not love to see this at Adobe's current share price because, as we're going to see, the stock is not actually cheap right now. So the company using its cash position and taking on debt to buy back shares at a high price, I don't think is the best decision on Adobe. And I think that the company would actually create more shareholder value by simply investing its cash into bonds and producing about a 5% return. Because the company's free cash flow yield is about 2.5% right now. So when you're taking a look at where capital could be the most effectively deployed, it's actually in bonds versus buying back the shares right now. And that would actually produce the most returns for shareholders. But that's my opinion. I know a lot of people disagree with me on buybacks, but that's how I think about it. Now, lastly, we can see that Adobe's cash and cash equivalents did decline by about $500 million on the quarter. And that simply is because the company is buying back so much stock. So now let's head over to Stock Unlock and take a deeper look at Adobe's financials here. So right here, we can see that Adobe's free cash flow in the trailing 12 months is in a little bit of a dip right now. And in the trailing 12 months, it is sitting at about $6.55 billion. However, Adobe did have a $1 billion acquisition termination fee in the past year. So this is kind of suppressing Adobe's cash flows artificially. And going forward, the company should actually have higher cash flows. So if we normalize this number and add back that $1 billion of acquisition termination fees that is suppressing cash flow, then it means that Adobe actually generated about $7.5 billion in free cash flow in the trailing 12 months now. However, we can also see that this basically means that Adobe's free cash flow has not grown in roughly 2 years now, and ultimately this means that Adobe's profits or its free cash flows are not growing with the company's overall revenues. If we head over to Stock Unlock's freeform tool, we can see this much more visually. The blue bars are Adobe's revenue, and the green bars are Adobe's free cash flow. And again, we can see that the free cash flow is not growing with the revenue, which is clearly continuing to uptrend. Adobe also gave us their outlook for the fourth quarter of 2024, and right here they are showing us that they are expecting revenue to be between $5.5 billion and $5.55 billion. I did the calculations, and this is revenue growth of about 9% year over year for the fourth quarter. So it seems like Adobe is expecting its revenue growth rates to continue decelerating into the fourth quarter of this year. And this is one of the main things that analysts were concerned about on the conference call. It's simply the deceleration of growth to Adobe's business. Additionally, Adobe is projecting about $550 million of net new annual recurring revenue in the fourth quarter, which is actually down 3% year over year versus the ARR growth that Adobe saw in the fourth quarter of 2023. And this was another thing that analysts were asking Adobe about because it's not very great to see that Adobe's net new ARR is projected to decline year over year, in addition to the decelerating revenue growth that Adobe is currently seeing. In fact, 9% year-over-year revenue growth will be Adobe's lowest revenue growth rate in nearly a decade. The previous low was 10.2% in 2023, and you can also see that Adobe's revenue growth rates have been slowing down since about 2017. And there were multiple years where Adobe's revenue was growing at over 20% annually. So it seems like the business is seeing some headwinds right now, or at least a strong deceleration in growth. So let's go and take a look at Adobe's price now. So on a GAAP basis, Adobe is trading for a price to free cash flow of basically 35 today. However, again, the company's cash flows are suppressed by about $1 billion in the trailing 12 months because of that acquisition fee. And on an adjusted basis, Adobe is actually trading for a price to free cash flow of about 30.4 right now, on basically a go-forward basis. We can also see that Adobe's 10-year historical average price to free cash flow is about 34.5. This does suggest that Adobe's stock is trading about 10% below its historical average price to free cash flow right now. But I do think that this is kind of warranted because Adobe's growth rates have been decelerating quite a bit over the past 5 years. Or in other words, I do understand why Adobe was trading for higher multiples when the business's revenue was growing at over 20% annually. But this is no longer a business that is seeing 20% annual revenue growth. So I do think that multiple compression is actually warranted for Adobe's business. And in my opinion, I do believe that a 30 price multiple for a business that is growing its revenue by 9% annually is a very expensive price to pay. So ultimately, I do believe that Adobe stock is still very expensive in the stock market. And I also do not love to see that Adobe's revenue growth rates are continuing to decelerate. There's also concerns that Canva is taking market share from Adobe, with Canva launching more business-specific tools. This article says, the Australian creative software company is pushing out features made for teams, including those in human resources, sales, and designs. The tools make it easier to modify graphics or large chunks of text to make them consistent with the organization's style, and allow a template for internal deck or newsletters to be pulled up with one click. By expanding beyond the consumer market, Canva is increasingly encroaching on Adobe's turf. The closely held company, which is focused on making easy-to-use products targeted at people without formal design training, raised funds at a $26 billion valuation this year and is trying to take advantage of the generative AI boom to speed up growth. We are bringing that exact same approach to enterprise, as we have done with the consumer market. A platform that's really easy to understand and use is critical. So it looks like Adobe is facing steeper competition in the digital creative space. This could partly be why Adobe is seeing decelerating revenue growth and margin compression. There's also an argument that generative AI is negatively affecting Adobe's business and causing its products to be less competitive. In other words, AI is potentially disrupting Adobe's business and attacking its moat. Now, to finish up this video, I want to do a quick discounted cash flow calculation of Adobe stock to show you why I think that the stock is still looking expensive today. So we are going to project out Adobe's free cash flow over the next 5 years, and I'm going to say that Adobe's free cash flow is going to continue growing at about 9% annually. The company is also going to continue buying back about 1.8% of its shares on an annual basis, and trade for a price to free cash flow of about 25, which I think is still pretty high for a business that is growing its revenues and cash flows by about 9% annually. With these inputs right here, we get a compounded annual growth rate to the share price of about 7% annually, and a fair value of about $443 per share, which is 13% below where the stock is currently trading. So basically, if Adobe can only continue to grow its business at 9% annually, and if it does see some multiple compression down to a 25 price to free cash flow, then the stock could underperform the overall indexes and only produce a 7% annual return going forward, which is not a high enough return for me to be interested in the stock, and therefore my conclusion is that Adobe stock is still looking quite expensive to me today, and I am not really interested in purchasing it at its current share price. However, Adobe is a stock that I do like to pay attention to because there are periods where it does look like it becomes quite undervalued, like it was in 2022. So if that ever happens again, then I may look to buy back into Adobe shares, but right now the stock is not anywhere close to where I would consider it a buy personally, and that's kind of my opinion on Adobe stock and its share price today. So with that being said, that is going to wrap up the video for today, everyone. And if you did enjoy this video or you found it helpful in some way, then please remember to leave a like on it because it does really help out my channel. Also, if you want to stick around and see more stock market related content like this, then please consider subscribing to my channel as well, because that would be pretty awesome. And lastly, if you are interested in checking out the platform that I use here to analyze stocks, do discounted cash flow calculations, and check out the financials of businesses, then this platform is Stock Unlock, and I am one of the creators of the platform. We're doing a ton of work to continue adding value to all of our users, and it is free to try out. So if you haven't tried out this platform yet, or if you are interested in checking it out, then you can do so for free by checking out stockunlock.com. But with all that being said, that's going to wrap up the video for today, everyone. So thank you so much for tuning in. As always, I truly do appreciate it, and I really hope to see you all again in my next one.